Basic concepts of accounting guides how business transactions are reported. On the basis of the four basic assumptions that we saw earlier, the following concepts of accounting have been developed. The concepts are dual aspect concept, revenue realization concept, historical cost concept, matching concept, full disclosure concept, verifiable and objective evidence concept. We will look into each of them briefly. Dual aspect principle is the basis for double entry system of bookkeeping. All business transactions recorded in accounts have two aspects, receiving benefit and giving benefit. For example, when a business acquires an asset, that is, receiving a benefit, it must pay in cash, that is, giving a benefit. In accounting terms, the two aspects are debit and credit. We debit an account when there is an increase in asset and increase in expenses, or when there is a decrease in liabilities or decrease in income or decrease in equity. We do just the opposite for credit. That is, we credit an account when there is a decrease in asset and decrease in expenses, or increase in liabilities, or increase in income, or increase in equity. The debit and credit is structured such a way that for each debit there is a corresponding credit and vice versa. So, if I buy a pen using cash, I make a debit entry in my asset account as my asset has increased, and I make a corresponding credit entry in my cash account as my cash asset has decreased. Similarly, if I buy a pen on credit, I make a debit entry in my asset account as my asset has increased, and I make a corresponding credit entry in my liabilities account as my liability to pay has increased. As per the revenue realization concept, revenue is considered as the income earned on the date when it is realized. Unearned or unrealized revenue should not be taken into account. For example, when a customer makes an advance payment of say rupees 5,000, it should be recorded under liability as work is not yet complete. Once the work is complete, it can be recorded in the revenue section. Similarly, if a work is done and delivered to the customer with a bill of say rupees 10,000, then the seller is assumed to have realized rupees 10,000, even if the customer is delaying the payment. This is because the delayed payment is a financing issue and not related to the realization of the revenues. The realization concept is vital for determining income pertaining to an accounting period. It avoids the possibility of inflating incomes and profits. As per historical cost concept, assets are recorded at the price paid to acquire them, and this cost is the basis for all subsequent accounting for the asset. For example, if a piece of land is purchased for rupees 5 lakhs and its market value is 8 lakhs at the time of preparing the final accounts, the land value is recorded only for rupees 5 lakhs. Thus, the balance sheet does not indicate the price at which the asset could be sold for. This is done so as to prevent speculation and intended bloating of the balance sheet. Matching concept requires revenues and any related expenses to be recognized together in the period to ascertain the result of the business concern. Matching concept requires revenues and any related expenses to be recognized together in the same period so as to ascertain the result of the business concern. It is the basis for finding accurate profit for a period, which can be safely distributed to the owners. For example, a salesman may earn 10% commission for a sale in January. The payout of the amount to him may be in February. However, one should record the commission expense in January so as to accurately ascertain the actual profit on the sale. Full disclosure concept emphasizes that the accounting statements should disclose fully and completely all the significant information. Based on this, decisions can be taken by various interested parties. It involves proper classification and explanations of accounting information which are published in the financial statements. Verifiable and objective evidence concept requires that each recorded business transactions in the books of accounts should have an adequate evidence to support it. For example, cash receipts for payments made should be available. The documentary evidence of transactions should be free from any bias. An accounting record are based on documentary evidence. As accounting records are based on documentary evidence which are capable of verifications, these are universally acceptable.